Did you know that not all income is taxed? It's an important concept, and unfortunately, a lot of people don't know about it. So in today's video, I'm going to talk about 4 types of income that's not taxed at the federal level. Let's go for a walk and we'll jump into it. Okay, the first one can actually be quite significant, and that is long-term gains on the sale of a house. So if you've lived in your house for 2 out of the last 5 years, the IRS says the first $250,000 of gain for an individual is completely tax-free. And if you're married filing jointly, it's $500,000. So if you paid $500,000 for your house and it's doubled in value and you're married and filing married filed jointly, if you sell it for $1 million, you've got that $500,000 gain. The IRS says, you know what, that's going to be tax-free income for you. Now, I need to share with you, I'm not an accountant. I don't play one on YouTube, and I'm definitely not one in the real world either. So this is not financial advice. Double check everything that I'm talking about here. In fact, did you know that the IRS actually has a YouTube channel? I did not until I was doing research for this video, but it's IRS videos. So if you just look up at IRS videos, you should be able to find them. Okay, so that's the first source of tax-free income. And like I said, that can be pretty significant. There's not many ways to get $500,000 federal income tax-free. Let's talk about the second one. Unfortunately, it's not as big as the first one, but it's still important. And that is a Roth IRA, distributions from a Roth IRA or a Roth 401k. Not only are the distributions tax-free, but the earnings that you achieved in the account is going to grow tax-free. So that can be pretty powerful. Be sure to look up what the requirements are. You've got to be over 59 and a half. It's a 5-year holding period, but Roths can be super, super important. If you're not utilizing a Roth, for a lot of people, those can make a lot of sense, either the Roth IRA or the Roth 401k. I need to say this isn't tax advice, and again, I'm not an accountant. Okay, let's keep going. The next one, and this one can be pretty significant too, long-term capital gains from your investments in publicly held stocks, basically your investments in the stock market. Long-term capital gains, which are positions that have been held over a year, so 366 days or more. Much of that, if that was your only source of income, actually, you're going to be surprised at how much you can actually earn and not pay federal income taxes. If you're an individual, it's $44,625. So if that was your only income, was the gain you sold on a stock, that much you'd pay a 0% federal income tax level. And if you're married filing jointly, it's double that. So it's $89,250. That's very significant. Also, dividends, qualified dividends are taxed currently in the United States for qualified dividends at the long-term capital gains rate. Again, yeah, and it's not separate. This is cumulative. So if you had a capital gain and dividends, you'd add those up. But the limits are the same. You could earn almost $90,000, not quite. It's the $89,250, and not owe any federal income tax on that. Again, this is if it was your only source of income. So if you're receiving Social Security, if you've got rental properties and you're getting rental income, all that money is added together and it's going to push you up into a taxable bracket. But the long-term capital gains and the dividend, qualified dividend tax rate, that's very attractive. Okay, the next one is something you've heard me talk about in previous videos, and that is a health savings account. Now, unlike with a Roth, where at least for the Roth IRA, there are income limits. Not everybody can contribute to a Roth IRA, though there's ways around it. If you just want to look up Roth conversion, you'll find all kinds of information, including previous videos of mine. But for the Roth 401k, you should be able to participate in that Again, talk to a tax specialist, talk to an accountant. But with the health savings account, there is no income limit. The government doesn't say, you know, if you make more than X dollars, you cannot contribute to a health savings account. The controlling factor there is you have to have what's called a high deductible healthcare insurance plan. And you can look that up. HDHC is the acronym, is the abbreviation on that. But the nice thing about the health savings account is you're putting money in pre-tax dollars. It's growing tax-free, and when you take the money out, again, there's requirements on this, 59.5 and a 5-year holding period. But when you take the money out, it's income tax-free at the federal level. So those are 4 really powerful ones. I've got a bonus for you here as well. Before I get to the bonus, and this is one that almost everybody watching can take advantage of. But my request before I get there is, if you're enjoying this video, give me a like. It really does help the YouTube algorithm. Okay, let's get on to this bonus one, number 5. And that, you know, Airbnb right now is really popular. And there is a minimal rental use rule, which essentially says 14 days or less, so you can actually rent it for 2 full weeks. 14 days or less, that is free of federal income tax levels. And again, you know, Airbnb is getting popular. It's not for everybody. Make sure, you know, you're complying with, if you have an HOA, if you have community rules, make sure that you're complying with those things. Really important, make sure that you have the right insurance. Because what you don't want anybody tripping and falling and suing you. And, you know, the nice thing is you only have to become financially independent once. And you would hate for something like that, something silly like that to happen and somebody sue you. So make sure you've got the right requirements, but the right requirements in place. But it is nice to know that you can rent out your home. You can rent out, you know, a lot of people rent out a room in their apartment or something for a short period of time. They're not, you know, it's not like it's a full-time Airbnb. But that can be important. And, you know, this is what I call tax alpha. And alpha is when you're outperforming the market. And there's different types of alpha. And alpha just means you're getting a bigger return than you should be getting for the risk that you're taking. And in my world, you know, the risk you're taking is called beta. And so alpha means you're getting a bigger return than what the beta would say that you should. And there's things called investment alpha. That's what everybody's, you know, hoping that they're going to find when they hook up with an investment advisor, with an investment manager. People like Warren Buffett, you know, folks would say, oh, he's generated alpha. He's done well with his stock picks. You know, that's a really, really difficult game to play. But this, what I call tax alpha, is something that everyday people, the 4 things and the one bonus that I've shared with you here today, is something that everyday people can benefit from. Another thing you can benefit from is 2 of my most popular videos. This one up here that talks about average income in retirement, and this video down here that talks about 5 reasons to retire as soon as you can. Thanks for watching. Bye-bye.